Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, S&P 500 and NASDAQ futures rebounding as investors weigh ongoing trade talks. President Trump says he had a, quote, productive call with the president of Mexico yesterday and that big progress was made in trade talks with Japan. Trump says every nation, including China, does want to meet, and Italy's premier will meet with Trump today at the White House.
Plus, President Trump taking aim at the Fed chair Jerome Powell on Truth Social this morning, saying that the Fed is late to lower interest rates and his, quote, termination cannot come fast enough. This after the Federal Reserve chair delivering perhaps his starkest warning yet on the potential stagflationary effects of Trump's tariff policies. He warned of the, quote, challenging impacts of the uncertainty that has hit the economy.
This will be indeed the golden age of America. It's coming back. We're going to come back very strongly.
Powell says the central bank will wait for greater clarity before considering cutting interest rates.
And shares of United Health plunging and weighing on the Dow, shares sliding after cutting its outlook for the year, citing a rise in care costs, quote, far above what they had expected. And overnight, Taiwan Semiconductor, chip manufacturer for the likes of Nvidia and Apple, jumping on upbeat second quarter sales guidance. The company keeping its growth outlook for 2025 with expectations for AI revenue to double.
Futures mixed this morning, coming off a day of losses following Fed Chair Jay Powell's warning on the impacts of President Trump's trade policy, saying it could be inflationary with potential of a so-called Fed put seemingly dead in the water. Are markets prepared for higher inflation or even a possible recession? Joining us now, we've got Yahoo Finance's Josh Schaefer. So, what is the calculus that's being run around this after the Fed's commentary yesterday?
Yeah, Brad, so I've sort of been asking equity strategists this question all week because essentially in the economics community, recession risks are rising, right? Whether someone has a recession call or they don't, they're certainly arguing that the risks to a recession are rising. So I've been asking strategists, essentially, are we priced for that in the equity market at this point? And we did a little bit of work with that, taking a look at a chart here that we made, just looking at large drawdowns for the S&P 500. So what you're looking at in green there would be the max drawdown seen from the index in years that the economy has been in recession. Notably, I would point out those green bars are significantly lower than the 18.9% drawdown that you've seen in the S&P 500 thus far, essentially arguing that just using a little bit of history, normally markets would fall further than we've seen at this point if we are indeed headed for recession. And I think that's largely, guys, what you've been hearing from strategists too. I was speaking to Citi's Drew Pettit. They recently lowered their S&P 500 target to 5,800, which would be up about 7% from where we are now, or 8%. But notably, in that call is not a recession, right? So essentially what strategists and economists are both landing on at this point is they want this trade war to de-escalate. They want the tariffs to come lower. If that happens, then maybe there's a path where there's not a recession. Maybe there's a path where the S&P 500 can move higher. If we stay in this uncertain period for too long, a lot of people are arguing the economy likely tips into recession, and perhaps there's more downside for the equity market.
And you were so smart to flag that the Powell commentary was going to be critical yesterday, Josh, and it was interesting hearing him not use the word transitory, and also from my understanding sounded a little bit more negative on the outlook, even though this is the first time we've heard him speak since we got news of the 90 days for negotiations. That was an indication to me that maybe those negotiations that we're hearing the president speak about this morning with Mexico, with Japan, are not going to be enough to potentially stop this train.
Yeah, well, I think there's a difference between sort of how perhaps the central bank looks at what this uncertainty does and perhaps what the administration looks, right? But in the economics community, a lot of folks would argue that the uncertainty you're creating right now just spins and spirals, and once you have sort of that downside spiral, there's not a lot of ways to really save that, right? Mm-hmm. And one of them would maybe be if the Fed came in and cut rates, and I think Powell made that rather clear yesterday, that there's not a clear path for them to be cutting rates soon, and that was just not what the market wanted to hear, net, right? And so when you think about sort of the two potential puts that are out there, the two policy arms that could come in and help the market right now, whether it be the administration or the Fed, both of them are sort of, as we know from this morning, from Trump's post, right, they're sort of saying they're not coming, right? They both of them maybe want the other one to come, but that help is not coming to the market at this point.
And so with that in mind, how are you hearing strategists increasingly talk about what their own projections, not just for the end of the year, but perhaps more immediately, this earnings season is starting to look like as well?
Yeah, Brad, I mean, I think the big issue right now, you saw it yesterday with what came out for NVIDIA, right? It's just this uncertainty coming from the administration, whether it be specifically tariffs or how they're putting in different legislations to challenge companies and challenge their shipments out to China, right? Using NVIDIA as an example. Uncertainty is just the word right now, and until that really changes, I don't think a lot of people feel that confident about what's going on in the market. I mean, I was talking to one strategist who said their S&P 500 EPS range right now is one of the largest they've ever had, right?
Yeah.
So, because you go from a range of maybe $220 in S&P 500 earnings per share to maybe 270, right? Because you're talking about just a wide swath of tariffs. Yeah. We don't know where it actually lands. So at least in the near term, you don't really know enough.
That's how you get a United coming out with two different guidance.
Right, United came out with two very different guidances, Brad.
Yeah.
One of them was okay, and one of them's really not that great, right? And so when you look at that, it's just like, what do you actually do with that as an investor? I think people are struggling with that, and of course the advice continues to be, find a company that you feel confident will still be a large part of the American culture in 5 to 10 years, regardless of tariffs, right?
Yeah.
That's sort of the prevailing take, but in the immediate term, I don't know. Maybe we'll get some clarity. I'm rooting for it.
In the immediate term, looks like tech is up. So I guess immediate term, okay.
After a big sell-off
this exact
yesterday,
second. Yeah, exactly. Josh, thank you so much. Really appreciate it. Well,
Treasury yields are rising this morning as investors weigh Fed Chair Jerome Powell's concerns about the state of the economy and amid President Trump's tariff rollout. Powell warned of the challenging impacts of tariff uncertainty to the economy, but says the Fed is in a wait-and-see mode.
We are well positioned to wait for greater clarity before considering any adjustments to our policy stance. We continue to analyze the incoming data, the evolving outlook, and the balance of risks.
President Trump once again criticizing Powell, saying that the Fed is too late and should have already lowered interest rates. Is the Fed behind the ball? Joining us on set is Blake Wynn, head of U.S. Rate Strategy at RBC Capital Markets. Great to have you on set as always here, Blake, and good morning to you. So, is the Fed behind the eight ball, or is that more so political posturing from the administration right now amid what the markets are seeing as a self-induced hit to the economy right now?
Well, in which direction do you mean? Because we have risks in both sides. I mean, we could find out in 6 months that they're actually behind the curve on inflation, or we could find out that they're 6 months behind the curve on, downside risks. So I think that's the problem facing the Fed. I mean, the analogy that I've been kind of using with clients, it reminds me of a goalkeeper in soccer kind of defending against a penalty kick. You don't know which way the ball's going to go. It could go to the inflation side, upside inflation risk. It could go to the downside on labor, thinking about their dual mandates. So if you preemptively jump in one direction before you see where the ball's headed, maybe you guess the right direction and you save it, or you end up very offsides to try to save it in the other direction. So Powell just wants to see which way that ball's headed before they actually start to react.
I'll just note that you sent that graphic to our team here, and I think it's probably one of the first times that we've received a meme-type graphic from RBC, so we appreciate that as well here.
Yeah, we certainly do appreciate the references to Ferris Bueller, the goalie references, but I am curious, Blake, because you had updated your guidance to 3 rate cuts this year prior to Powell's commentary. I just asked you, has that changed since he spoke? You said no. How much damage do you anticipate happening to the economy to justify 3 cuts this year, given Powell's commentary about not being in a rush?
Yeah, and I think there's kind of 2 fronts that we've been thinking about this on. One is the actual impact from whatever tariffs end up being in place over the next 6 months to a year, right? So you have the actual drag that's coming from that. And if you look at that, there's huge amounts of uncertainty. We have no idea where it's going, but we have to make some kind of base case. And I think it's very, very clear that that base case is worse for us than it was 2 months ago. Even with the pause, I mean, we're looking at an effective tariff rate that's still the highest we've had in 100 years, right? So that's going to drag. I think the second piece, and I think Josh really hit on this very well, right, to focus on the uncertainty, there's the impact of the tariff itself, but then there's the uncertainty that this is causing. So even if you may not be directly impacted by a tariff that's in place right now, are you buying new equipment? Are you hiring new people? Are you leasing new land, expanding your business? Yeah. And I think that's toothpaste that's very hard to put back in the tube. You've rung that bell, the uncertainty is there, you've injected it into the psyche of C-suites and consumers.
Right.
It's very hard to unring that bell.
To that exact point, I want to talk about the Philadelphia Fed survey from this morning. This is obviously only one region, but some of the data in here really jarring. Prices paid soaring, employment way down from previous levels, new orders in the negative, way below previous levels as well. Again, obviously just one region, but to what extent is that an indication of data that could show up in the hard data that the Fed looks at sooner rather than later?
That is the question, and I think when Powell says he's wait and see, what we're waiting to see is if all of the negative sentiment that's been showing up everywhere, I mean, it's in all the consumer surveys, all the business surveys, for several months now have been showing that there's a huge amount of uncertainty on tariffs specifically, but even around some of the DOGE stuff, the cuts as well. The real question is, how is that going to cross over into the hard data? And I think that's a difficult question right now because we have had a period over the last few years where the soft data, the survey data, has not really matched up with the hard data. Yeah. And that has persisted for a while. So usually you would look at the soft data and say that's a leading indicator. If people are very down on the economy, they're going to behave in a way that ends up dragging on the hard data. But given that didn't really happen very much over the last few years, I think it's right to be somewhat doubtful if that's going to happen. But that's what we're waiting to see, is the downside that has been very clear in the survey and the soft data. Is it going to cross over into the actual activity data? I think March is too early. It's not going to be in the March data. We need to wait until that April-May data to see that really starting to build.
And so how would what you're seeing in the data also then go and influence your modeling for rates right now and kind of over the next perhaps 3 to 6 months for investors out here who are trying to look out into the future and best figure out, okay, where that rate strategy should influence their investment decisions as well on the back end of that?
So the hard part about the rate outlook right now too is that you have a lot of uncertainty at, let's call it a 1 month time horizon. I feel much more confident about a 3 to 6 month horizon, right? Yeah. Because there's just so much noise right now. There's a lot of volatility. There's a lot of positioning that's been shifting around that has caused some of the volatility we've seen over the last 2 weeks. So I feel very unsure about where things are headed over a 1 week, 2 week type of time frame. But I feel more confident that if we're talking kind of 3 to 6 months, that those downside risks, that crossover from the soft data to the hard data is going to happen, and that is going to start to pull yields lower. I also think that probably comes with a bit of curve steepening, because I think that's more in cuts being priced in the front end, whereas the back end, we still have some of these concerns around term premium, around supplies, deficit. You've heard rumors of foreigners selling assets. So I think that's probably going to keep the back end from kind of performing in the same way as the front end. So we get a little bit of that curve steepening. Yields come lower, but it is with a bit of a steeper curve.
Continuing on that, I'm curious your thoughts on the safe haven status of U.S. Treasury bonds, especially in the context of President Trump posting about a potential termination of Fed Chair Jay Powell. Unclear if he was talking about when his term is up or a more immediate termination here. To what extent does a statement like that and also the policy uncertainty from Washington put the safe haven status of the U.S. at risk?
Yeah, I mean, the way I've been kind of talking about is the stability premium that we've enjoyed for a very long time is in question right now. But I've generally been a bit of a seller of this theme because it's tough to figure out where you go. I mean, there are network effects to owning treasuries. I mean, treasuries are still where the liquidity is. It's a very, very deep pool of assets. There's no other foreign sovereign bond market that could absorb the kind of flows the Treasury does. And it's very hard to move away from. I've actually been likening it to the move away from Twitter. I mean, multiple times we've heard people say, we're going to Blue Sky, we're going to Threads. It just never quite seems to happen because you get over there and realize that nobody else is over there. And so it's just very hard to pull away from treasuries in any large way. Now, I think over the next few years, that's going to be a theme that we watch very, very closely. And I do think on the margin, these long overweights that people have held in U.S. assets may start to level out a bit. Like I said, I'm a bit of a seller of that, but even marginal moves, if you have a global bond portfolio and you go from 40% U.S. Treasuries to 35%, if a lot of people do that, it could still be pretty meaningful. So definitely a theme we'll be watching.
Blake, great to see you this morning. Thanks so much for taking the time here with us on set. Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street, and investors are watching shares of NVIDIA. The chipmaker declining to comment directly on CEO Jensen Huang's meetings in Beijing, but a spokesperson told Yahoo Finance the company regularly meets with government leaders to discuss its products and technology. We'll discuss that and much more on Morning Brief. It's now time for some of today's trending tickers. We're watching United Health, D.R. Horton, and Hermes. First up, United Health shares plunging after the health insurer slashed its earnings forecast for the year, citing rising costs that took the company by surprise. United Health's warnings about rising costs also weighed on rival health insurers like Humana and Aetna owner CVS. United Health is the largest seller of Medicare Advantage plans and saw care activity rise more than expected during the quarter. That division was also impacted by Medicare payment changes the government made to crack down on insurers. Shares down 16%.
And next up, home builder D.R. Horton cutting its full-year revenue outlook as it grapples with a muted spring selling season and weak economic backdrop. The company's executive chairman said would-be buyers are more cautious given affordability constraints and declining consumer confidence. Both revenue and earnings per share falling short of estimates in the company's fiscal second quarter. D.R. Horton closed roughly 19,200 homes during its most recent quarter. That is a 15% decline from the same period a year ago. And finally here, Brad, go ahead.
Hermes says it will raise prices in the U.S. to offset the impact of President Trump's tariffs as a global trade war intensifies. The luxury brand's first quarter results were dented by weakness in the greater China market. Total sales rose 7.2% on an annual basis, just shy of analyst expectations. Earlier this week, Hermes overtook LVMH as the world's most valuable luxury group by market cap after LVMH's weak quarter sank the stock. You could scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's Trending Tickers page.
And Taiwan Semiconductor Manufacturing Co. is projecting confidence in the face of tariff-driven pressure, leaving its full-year growth outlook unchanged. The Taiwanese chipmaker had a robust first quarter, topping analyst estimates with a 60% year-over-year net income increase. The report comes after new U.S. export controls roiled NVIDIA and the broader chip sector on Wednesday. Here we've got Patrick Moorhead, Moor Insights and Strategy founder, CEO, and chief analyst. Patrick, always great to speak with you here. Talk to me about your big takeaways from this TSMC print, given the fact that it's being seen as such a bellwether in an industry for tech that took a huge hit in markets on Wednesday.
Yeah, zero surprises for me. I mean, essentially, this is all dependent on this Mag 7 CapEx build out. And it's not that Apple isn't relevant in this scenario, but Apple got a reprieve on the tariff situation. So that's looking pretty good. TSMC, while they didn't use the word sold out, they are essentially sold out for 2025 leading edge wafers. And regardless of the ebbs and the flows right now, this continues. But, all bets are off if we see big tariffs in semiconductors or reinstitution of the smartphone and PC tariffs that were that went away last week.
Patrick, I was running some charts this morning, just looking at the gross margins that have become a little bit normalized and steadily grown for TSMC. And that's even with the introduction and increasing talk and investments around some potential competitors in the future. But it really kind of solidifies how much they are the de facto type of play here. Even with potential competition in the future, are these margins attainable over a longer term period of time? We're talking levels between and the mid kind of 55%. I think the average is at about 57% gross margin for this company. Is that something that's able to be replicated even with the entrance of new competition in the space?
Yeah, so TSMC margins are obscene or obscenely awesome, depending on which lens you want to look at. And there's talks of a 30% price increase in the U.S. And right now, they're essentially testing their ability to raise prices. And what TSMC will say is that we need this money to go in and do some massive capex, but with profits raising and capex raising at the same time, it doesn't look like this. I think this opens the door for companies like Intel, for companies like Samsung to take some high-end market share away from TSMC. I would put 100% chance that on a percentage basis, TSMC loses market share. All it takes is Intel or Samsung to get one major customer, and this will happen.
Just very quickly, Patrick, a follow-up regarding TSMC amid the Trump administration. What is the potential headwind that this company could be facing, because they've already been threatened with more tariffs, or taxes rather, if they don't produce in the U.S.?
So I think you nailed it right there. I mean, the biggest headwind they have is the threat of tariffs. The second would be if the U.S. economy or the global economy goes into a recession, and that puts pressure on the Mag 7 CapEx, which then reduces the amount of those high-end GPUs and high-end CPUs and accelerators that are driving this economy today.
Super quick, Patrick, to what extent do you foresee TSMC's results this morning impacting Apple moving forward?
So I don't think it impacts Apple at all at this point. Again, TSMC's forecasts were based on no huge changes in Apple business. That could change with a tweet. It could change with an executive order on any changes to not only semiconductor tariffs, but also devices that come out of China that would dramatically and very negatively impact Apple.
Yeah. And Patrick, I'd be remiss to not talk to you about NVIDIA. NVIDIA taking a $5.5 billion hit due to export controls, the stock dropping significantly off the back of that, just barely above the flat line today. CEO Jensen Huang is in Beijing, according to state media. Right. Talk to me about what this tit for tat over tariffs means for NVIDIA. Just how big a headwind is it for NVIDIA to be able to beat the street's sky high estimates moving forward?
Yeah, so H20, while a $5.5 billion write-off is not zero, I think the biggest risk here is if this escalates. And with NVIDIA, Intel, and AMD doing between 20 and 30% of their business inside of China, that's the biggest threat, that it escalates and gets into not just data center accelerators, but also notebook GPUs, gaming GPUs, CPUs from AMD and Intel.
And so with that in mind, at this juncture, for investors that are trying to best game out what they're seeing actually in some of the options AI market as well, I mean, this is a potential 11% move to the upside or downside by this next time NVIDIA reports earnings. What should they be kind of looking at as either a psychological marker or perhaps a technical marker that determines whether or not this is a safe level to invest?
Yeah, I think looking at the psychological marker, which is, and not too many people are talking about this, I think the Trump administration has painted itself into a little bit of corner and is trying to find a way to get out of this. Because they know that if you bring down Apple, you bring down NVIDIA, you're tanking the market. So I feel pretty confident over the next 90 days that this is going to be resolved. I think it'll be hard for NVIDIA to give a rock solid forecast, but I do think that they will give one based on the information they know. And then out the other side of their mouth, they're going to say, these are the risks of that forecast.
So then, Patrick, which chip's name should investors who have a long-term horizon be investing in right now?
Long-term horizon, 5 years, I believe that the best bet is Intel. And that might come as a surprise to everybody out there, but it's trading near book value. Its 18A and 14A process are on schedule. We're going to continue to have a push on U.S. company, U.S.-built semiconductors. All Intel has to do is hit a couple of not home runs, just getting to second base, and you're going to see Intel move a ton. And also Lip-Bu Tan, we haven't seen any of the big decisions that he's made yet as a new CEO. And I think whatever he puts out there, whether it's massive job cuts, R&D cuts, sale of assets. He just unloaded Altera. I think these will be positive news for investors with Intel.
Yeah, I was just about to acknowledge that, Patrick. It's a larger question of how much of the business as we know it right now is still intact, or if there's a kind of sum of parts that we're going to be looking at in the future. Right. Patrick, as always, thanks so much for taking the time.
Thank you.
We've got all your markets action ahead. Stay tuned. We've got the opening bell on Wall Street. You're watching Morning Brief.
And that is your opening bell this Thursday morning on Wall Street, the last trading day of the week in a holiday-shortened week, but one that has been full of volatility for investors here. Let's take a look at the major averages this morning. Your Dow Jones Industrial Average under a bit of pressure off the back of those earnings from United Health. But as we wait to have our boards adjust here, you can see, I'm having a little bit of trouble with people drawing on the interactive at the moment, but the S&P 500 is up this morning. Your tech-heavy NASDAQ also up as tech rebounds off the back of those losses yesterday. But you can see the Dow Jones taking it on the chin primarily here. I just want to quickly go back to our tech-heavy NASDAQ so that you can see just the volatility that we've seen over the last couple of days. Oh, you can't because the interactive's not working. So I'm going to send it over to our Yahoo Finance's Jared Blickery for a broader look at what the sector action looks like this morning.
Well, thank you. Yeah, we got a lot of quotes coming in and things seem a little bit delayed here, so we'll work beyond the ghost in the machine. NASDAQ, it looks like it's up just a little bit, but stocks are coming off their worst day in about 4 sessions. We saw a resumption of volatility, and also I want to mention that today is options expiration. Yes, Thursday is options expiration in lieu of tomorrow, which is a market holiday. So we'll be tracking that as well. Could add a little bit more volatility to individual names. We actually see volatility tend to go down in the indices on these days, and that's just on average. VIX, I want to talk about volatility here real quickly. VIX is holding the 30 level. That's just kind of a psychological level, but the main point is that VIX has kind of found support around in here, and if it refuses to go lower, well, that just means that the uncertainty in the markets is not subsiding, and so that's something we got to keep an eye on. Looking at the dollar and also yields, those were relatively muted this morning, so I'm going to kind of skip over those and go right into some of the sector action. And here we can see tech, actually energy is leading right now, up over 1%. We're seeing crude oil, if I have time, I'll get to a chart of crude oil breaking to a multi-day high. But healthcare, we were talking about those United Health earnings, that is the only sector in the red, down about 0.5%. Let's get over to the NASDAQ 100 where we have Apple. It has been leading the Mag 7 in the pre-market. It is doing that as well. In the early minutes here, Apple up about 1%. You can see NVIDIA, that big red square, that's down about 1%. Tesla just kind of oscillating around the unchanged line. Not a lot happening there. So I'm going to move on. I was looking at the sector action for financials in particular, and that is a sector where we have a lot of earnings ongoing right now. And I want to point to this almost picture-perfect pattern that is developing, which is a little bit bearish. This is a head and shoulders top that we're seeing here. We have penetrated that, and then we have gone back up to the resistance line, which used to be prior support, and now that is a pretty bearish impulse. So if the pattern plays out, I would expect this to move lower over the coming days, but it doesn't have to happen that way. Futures, we are looking at crude. I mentioned that was jumping to an 8-session high. Also seeing gold at a record. And also want to mention, I got this from Charlie Bileo, gold is now outperforming SPY. That's the S&P 500 ETF over the last 20 years. So gold, a better asset than we would have thought maybe a year ago.
Jared, thanks so much. Teeing up today's trading activity perfectly. Appreciate it. It's time now for today's strategy session. We're seeing the S&P 500 and the NASDAQ open higher, rebounding from the Powell-led sell-off, but we are seeing United Health earnings weigh on the Dow. And year to date, it's been a tough one for stocks. All 3 major averages are in the red. So how do you manage your investments amid the volatility and uncertainty? Joining us now, we've got Carol Schleif, who is the Chief Market Strategist at BMO Private Wealth. Good to see you, Carol. So just take us into your own evaluation, especially we're early innings earnings season. We've got the Fed talking about the potential risks that tariffs bring to the economy and acknowledging what that means in their own broader kind of policy pathway here. How is this all translating into investment strategy?
Well, I think the important thing is coming into this set of volatility is we've been diversified in portfolios for a very long period of time. And it was interesting because even when you looked at the through March 31st performance, those globally diversified portfolios, a lot of international bourses were doing better than the US markets were because of a lot of the volatility that we've talked about and the uncertainty that's been introduced basically since January 20th as markets and investors in the US and around the globe have dealt with the policy changes and the tariff on again, off again, and what's going on there. But as you talked about, in the short run, there's a lot of potential volatility. We are more positive, if you will, about the back half of the year. And hopefully we get some narrative change in where the focus is of investors. But that means that diversified portfolios are really important to have because not only did those international bourses perform very well, but fixed income overall has provided the ballast in the intermediate term that you need it to provide, aside from the fact that the last week or two have been exceedingly volatile, even in fixed income.
And given, Carol, that you talk about gains to come in the second half of this year, that makes me think that you anticipate tech having some gains since they're so heavily weighted on the major averages here. Where are you seeing areas of opportunity within the tech sector for investors?
Well, we think it's not necessarily just tech, but we think it's broader out there in terms of a lot of that spending is not going away. We do think you'll get the narrative shifted because keep in mind, our President Trump 2.0 is the mirror image for markets of what Trump 1.0 was in that in the initial, in the first Trump administration, we had tax cuts first and then tariffs. And here we've got the tariffs and the policy changes first that have impacted or drawn into question sustainability of growth and durability. And even on the fringes, people are questioning the investability, if you will, of U.S. markets. But we think the narrative starts to shift later in the year towards tax, things that are pro-growth from a tax standpoint, if they can get some of the accelerated business deductions put back in and the focus on rebuilding here in the United States. And you really see some action there where shovels are in the ground, plants are starting to go up. So it's not just technology, but it's broader industry in general as well. But we also think especially the software components of technology should continue to play because as companies deal with increased tariffs, they've got to figure out ways to put margin, things that can potentially support margins in, and the continued deployment of technology is really important from that perspective as well.
Carol, with that in mind, I question what it means and what you're seeing when you are looking at some of the businesses that are just trying to operate through this uncertainty and pulling back on some of the big deals that they were planning on making, or perhaps even big purchases into things like software. Perhaps they don't think they need more licenses or more seats or to add on. So that creates a major headwind for some of the software companies that have already talked about elongated deal cycles even coming into this year and more deal scrutiny. So within the software thesis, who is best positioned despite some of those headwinds that we had already seen start to rear their head?
Well, the interesting thing is it'll vary by size of company. Some of the big companies that are doing better here, if you will have the opportunity to be able to redeploy, especially if attrition takes headcount down and they're looking for opportunities. You've also got AI deployment, which we've seen from some of the initial statistics that small and medium-sized businesses, which may or may not be publicly held, but smaller, medium-sized businesses can really benefit from the AI deployment that's going out there. Now, we're prevented from compliance from talking individual securities, but there are, as you alluded to, a lot of moving parts here in figuring out how companies are going to respond. The interesting thing is for those companies that have debt with banks and lenders and public shareholders, they can't sit forever on the sidelines. They have growth objectives that they have to adhere to, and so they've got to figure out how do they tweak things through, how do they work it through the economy. And it's exceedingly challenging time to be a business owner, but we think the durability and the the flexibility that they've shown over the last 8 to 10 years with all the challenges they've been faced with will serve them well in this environment as well.
Carol, thanks so much for making the time. Appreciate it.
Thank you.
American Express reporting better than expected first quarter results and maintaining its full year guidance on strong consumer spending. Still, you're looking at shares down nearly 2% after the report. Our very own Brian Salzi spoke to Amex CEO about these results. He joins us with his key takeaways. Hey, Brian.
Hey, Madison. Yeah, right off the phone with Amex CEO Stephen Squeri. A couple takeaways here right off the bat. This quarter, I think, surprised the market. It surprised investors. And you can't help but to come away, Madison, thinking, how long could this demand trend continue? Up almost 10% on the top line for Amex. That is a result I think a lot of folks didn't expect, especially after results out of Delta and Nike a couple weeks ago. Of course, Delta works closely with Amex. Now, second thing, speaking of Delta, watch these airline sales. Squeri telling me airline sales up 4% in the most recent quarter. That is a deceleration from the 13% growth rate in the fourth quarter, something to watch there. Booking trends for vacations, of course, a forward-looking indicator. Next up, it pays to be an Amex, have the Amex customer base. Why the company was able to beat, I believe, is because they have a lot of customers with high FICO scores or really good credit scores that are not, that do have the money to go out there and spend, even if the market declines or has been under pressure like we saw in April. And to that end, guys, you got to look at this other stat that Squeri told me. So far through April, through the first 12 days, seeing no deceleration in sales. That is a big, I would say, upbeat indicator for a company like Amex to see the market under pressure, wealthy consumers perhaps starting to think about how they might spend in the back half of the year, and Squeri not seeing any change in demand. That is very interesting. Bottom line, why are you seeing the stock decline? I would offer you this. Anytime you see a company like Amex, or any company for that matter, beat big on guidance like Amex did today and not raise their full year guidance like Amex did today, the market will usually read it as they are concerned about the back half of the year. I didn't pick up that concern when I talked to Squeri. Nonetheless, that's how the market thinks.
All right, Brian, thanks so much. We'll continue to watch shares of AXP going on throughout the rest of today's session. Coming up, everyone, new vehicle sales surging as consumers try to beat potential price increases from tariffs. What automakers are saying about the Trump administration's policies? That's next on Morning Brief.
We don't have any imminent plans to raise prices as a result. We want to understand what the impact is and see how the market materializes going forward.
We understand, of course, the need for investment in the U.S., and we are playing a part of that. We have a plan for our customers. So we launched our Hyundai Assurance Program, which is confirming and assuring to the customers that MSRPs are not going to go up, in this at least this couple of months. So we are very good in uncertainty.
You just heard from auto industry leaders at the New York Auto Show this week, diverging from automakers like Ford this morning as the company teases price hikes due to tariffs as early as this May. All vehicle imports in the U.S. currently facing that 25% tariff and additional tariffs on auto parts set to take effect by May 3rd. President Trump has floated the idea of pausing some of these tariffs. Joining us to make sense of the back and forth, John Bozzella, Alliance for Automotive Innovation CEO and President. John, great to have you on this morning. Where do the automakers sit today? Because we have some folks telling our reporter on the ground at the auto show that they're not going to increase prices. And then you've got Ford, who makes 80% of their cars here, 80% of their production is in the United States already, saying they have to raise prices.
Yeah, we're right in that the midst of maximum uncertainty. Yeah. So here's what's happening. Automakers, and you heard this in your lead-in part of the segment, are committed to building more here in the United States. And we share this ambition with the president. We want to build more vehicles in the United States, and we have the capability and the capacity to do that. We want to build more parts and major components in the United States. There's no disagreement there. The challenge is, how quickly can we do this? These are massive, complex facilities and supply chains that just can't move overnight. And so what you're seeing is there's going to clearly be some impact in the near term with tariffs. That impact is probably going to be twofold. One, prices are likely to go up, and therefore sales are likely to go down as companies are adjusting and then bringing more production here to the United States. So that's the tension you're seeing. Yeah. It depends on where companies are in that continuum, I think, is what those announcements are telling you.
How much more does this cost consumers for cars in the near term?
Yeah, it's hard to tell, right? Because, but it's going to cost everybody something. And the reason for that is that there's no purely American car. There's no car that's 100% American.
Because of parts and where they get
Because of parts, right. And we have relied as an industry, for example, on duty-free trade across North America for over a quarter of a century. And that has made the U.S. industry more competitive, more dynamic, and has provided more affordable vehicles to consumers. And so as we start to unwind that, and especially as parts tariffs kick in, there are going to be price increases. I've seen ranges from $3,000 to $9,000 per vehicle. It's just really hard to know. But there's no question that these increases could be sizable.
Help me square that with what I heard you say earlier, that there is a will and a capability to move this manufacturing to the United States. Do automakers really want to do that? Like, for the real, when you talk to them, when the cameras are off, do they really want to do that?
I think that companies that operate here, here's the way the business works. You want to build near your consumer ultimately, right? It makes sense in an industry with long lead times and where you're trying to understand what the customer wants, maybe 3 years after you're starting to design and develop the vehicle. And so I think most companies have an ambition that they want to build where they sell. Now, what you have to recognize, and if you look at this market benefits from a mix of domestic produced vehicles and imports. What that mix does is it provides more affordability and more choices for customers, especially at the low end of the market, where you see most of those vehicles below $30,000 are imported. And so you have to have that balance. So what companies are saying is, I think I'd like to do more, and I think I can in some cases do more, but I don't know to what degree everything comes back, and because I think you need a more vibrant market.
From what you're hearing from companies, how are they factoring in who is building these vehicles? And specifically, I mean, you've got humanoid robots that could be running around some of these factory floors at Tesla in the near future. Elon Musk loves to talk about Optimus and all of the great things that are going to come there. But that's a direct impact on the number of employees in other manufacturing plants that have jobs, have had jobs for decades, and are trying to make sure that they're continuing to be part of that fabric as well.
Yeah, look, the jobs question's a big one, right? Automotive production in the United States is very efficient. It's a high productivity business. You do see a lot of automation. In other parts of the world, maybe less automation. So as vehicles come here, vehicle production comes here, it may be a little bit more highly automated than it was in plants in other parts of the world.
All right.
John, thanks so much for taking the time here with us.
Thank you.
What was your favorite concept car that you saw at the auto show? Huh?
Oh my gosh, you'll get me in trouble.
I know.
I will say there's a Genesis concept car, which is an off-road SUV with the most elegant lines you've ever seen.
All right. I'll have to check it out.
There you go. For us New York City drivers.
Exactly.
Take a look.
Right. I can take that one over the Williamsburg Bridge. John, thanks so much for taking the time.
Thank you.
We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. Eli Lilly shares surging after announcing positive results for its GLP-1 pill. In its phase 3 clinical trial, the pill would offer an alternative to popular weight loss injections like Ozempic. Our very own Anjali Kemlani joins us with the latest. Hey, Anj.
Hey, Brad. Well, let's stay on brand here with Lilly. Okay, so it's Mounjaro, not Ozempic.
Mounjaro.
Just letting you know. Just good news from Lilly. Top-line data showing that their pill is in fact efficacious, possibly on par if we look broadly out at what investors are expecting with Wegovy or the semaglutide drugs, which we know have a little bit lower efficacy. So what we saw was the patients lost about 16 pounds or 7.9% of body weight. They did, of course, also focus on the diabetes population and lower A1C levels, which is, as we recall, the goal of these drugs. The secondary endpoint is actually the part that we're all paying attention to, which is the weight loss. Something to keep in mind, too, is that analysts are looking at this and how it's going to boat for Lilly. Now it is the only player. We remember Pfizer just dropped out of developing its own, and those were the two sort of in the lead for the big pharma players. And so now we just have Lilly making it down to the finish line. Top line data now, broader results expected in Q3, and then possibly a filing for later this year, early next. Analysts from JPM saying we see today's data as highly comparable with injectable semaglutide, like I just said, and remain confident in orforglipron's ability to show 13 to 15% weight loss in the upcoming obesity readout in Q3. So more to come, essentially, for this story.
Anjali, just to get a take that consumers listening might be interested in, when can people expect to have the ability to take this pill? And also from the company perspective, could that eat into their share of profit from the injectables?
Well, I think let me answer that last part first, because I think what both Lilly and Novo have said is that there's way more demand than supply. So I don't know that eating into is really, I think what you're going to see is like a split of the market. So those who are just starting their journey or those who need more drastic weight loss will, skew injectable, and then more maintenance, and those who are okay with a little bit lower results will end up on the pill side. Yeah. But broadly speaking, it just means more revenue for Lilly, and pills are cheaper to make. So that's another part of the consumer too. Cheaper for consumers too. So that's going to be, really the key driver here, and why Lilly gets to sort of inch up in this, two market lead horse race here between Lilly and Novo.
And potentially available as early as next year?
Yes, that's correct.
Early as next year. All right, Anjali, thank you so much. Great breakdown as always. Huge move on Eli Lilly stock this morning. That's going to do it for the morning brief. Join me in the next hour for more analysis on Catalyst, and then you can catch Brad at 11 for more on wealth. Stick around.